All right, what's going on, guys? This is Brian. Just wanted to make a part two on my original gamma and options data video. So I want to first start this video out by giving a little disclaimer and public service announcement because there's a lot of services out there nowadays, especially with the abundance of AI and all that, that they claim to be giving you the correct options data and the correct GEX levels and whatnot, but in reality, it's just the underlying data that they use is just completely wrong. It's just fundamentally wrong. A lot of the services out there that you'll find, their positioning chart looks like something like this, where there's clear long gamma or long options above, and then gamma short options below. And you'll see these terms like gamma flip or call wall or put wall, and there'll be a clear line in the sand basically where gamma flips from one environment to another. And if you see something like this, just be careful. It's not the correct way to do things. The data that they use is not correct. There's two different data feeds that services use. One is the correct one that the CBOE releases that tells you exactly what the positioning is, and the other is the cheap option. The real one's like 50K a month now, and the cheap one is like 2. So that's why a lot of services out there use this approach. And basically, why you know it's wrong is because it assumes that market makers are only short puts and long calls, which just fundamentally is not true. You could see it on any other platform that is inherently wrong. So just be careful if you're looking for a service, if they do it this way or if it looks like this, that it's just fundamentally wrong. The real positioning data will provide something like this where it's long and short spread out throughout the profile and the range. And basically what this is showing is on the right side, we have strikes where the market makers are net long options, which means they have positive gamma. And then on the left, showing where market makers are net short options or negative gamma. So if it looks something like this, it's correct. If it looks like this, I would stay away. It could be very misleading. So before I get into the new stuff, I just wanted to quickly recap. So there's two different environments we can be in, either positive gamma, which means market makers are net long options. And if we're in positive gamma, the market makers will hedge in the opposite direction of the price. So if the spot price is going up, market makers hedge by selling. And if spot price is going down, market makers hedge by buying. And with negative gamma, this just means that they are short options. And in negative gamma, market makers will hedge in the same direction of price. So if spot price is going up, market makers will hedge by buying. And if spot price goes down, market makers will hedge by selling. And then quickly going through this grid, for a long call position, they have positive delta and positive gamma. So to offset the initial positive delta, they need to sell futures. As spot price goes up, their delta goes up, so they have to sell more futures. As spot price goes down, their delta goes down, so they got to buy futures. Short call, they have negative delta and negative gamma. Their initial hedge to offset the negative delta is to buy futures. And if spot price goes down, spot price goes up, their delta goes down, they got to buy futures. If spot price goes down, their delta goes up, so they got to sell futures. Long put, they have negative delta, so again, to offset that, the initial hedge is to buy futures, and they have positive gamma. If spot price goes up, delta goes up, and they got to sell futures. If spot price goes down, their delta goes down, and they got to buy futures. And then the last one, short put, they have positive delta and negative gamma. So to offset the positive delta, they got to sell futures initially. And if spot price goes up, delta goes down, they got to buy futures. If spot price goes down, delta goes up, so they got to sell futures. Note that for both long call and long put, so either way, if you're long an option, you have positive gamma. And if you're short an option, either a short call or a short put, you have negative gamma. So one thing I didn't touch on last video is the charm aspect, which is pretty important. And basically what charm is saying is as the delta or as time expires, the delta of the option is going to decay and change. And based upon that change in delta, the market makers will have to hedge accordingly. So if they're long options and price is below the strike, charm forces price up back towards the strike. So as time expires and as their delta decays, they will have to buy. If they're above the strike, charm forces price down back towards the strike. So this will be selling as time expires and their delta decays. For short options below the strike, charm forces price away, so continuing down away from the strike. This is because they have to sell as the time expires and the delta decays. And above the strike, charm forces the price away up from the strike. And this is because they got to buy as the time expires and their delta decays. Charm is most influential the closer to expiration the option becomes. So 0 DTE options will have the greatest charm impact. And as the day goes on, those 0 DT options, the charm will be greater. So now I'm just going to go through some of the different positionings. So first, a long call. So what do we know from this? Long call is positive delta. So the initial hedge is to short futures. Actually, let me back up. So options, 0 DT options, they have a shot clock. They either expire in the money, out of the money, and then based on that, their delta either goes to 1, 0, or -1. So for a long call, the scale would be it's either 0 if we are below the strike or 1 if we're above the strike. So if we're above the strike at expiration, delta goes to 1. So their delta is increasing. So that means that the market maker has to sell more and more futures to offset that delta. So they don't have enough of a short position. If we're below the strike at expiration, delta goes to 0. So they have futures to buy or cover because they are too short. So their initial short position, they don't need as much, so they got to buy back those shorts. So this is what causes the magnetic influence, because if we're above the strike and as time expires, that selling of the delta pushes price back towards the strike. And same if we're below, that buyback pushes price back towards the strike. And then long put, the scale for long put is either 0 or -1. So a long put has negative delta, and to offset that negative delta, the market maker is long futures. So if we're above the strike at expiration, delta goes to 0. So they have futures to sell. They have too much of a long position. So they don't need enough, or they don't need that much, so they got to sell them back. If we're below the strike at expiration, delta goes to -1. So they have more futures to buy. They are not long enough. So again, this is the same scenario as the long call. If we're above the strike, they have futures to sell, which pulls the price back towards it. If they're below the strike, they have futures to buy, pushing price back to it. Also, should throw a disclaimer is I'm simplifying this very much. It's not as simple in real market, but if this was the only position in the market, this is how it would behave. So next one is a short call, negative delta. So they have a long futures position. Delta scale is -1 if it's above, or 0 if it's below. So if we're above the strike at expiration, delta goes to -1. So they have more futures to buy. They don't have enough of a long position. So they got to buy more. If we're below the strike at expiration, delta goes to 0. So they have more futures to sell. They're too long. Their long position is too big, so they got to sell them out. So instead of the force that pushes price back to it, like with the long options, this is the opposite. So if we're above it, we have negative gamma. They got to buy futures as time expires. So it pushes away. And then if we're below it, they got futures to sell. So it pushes it away from the strike. And then the last scenario, short put. This is positive delta. So the initial position is short futures. And the scale is if we're above it, delta goes to 0. If we're below it, delta goes to 1. So if we're above the strike at expiration, delta goes to 0. They have more futures to buy or cover. They have too much of a short position. And if we're below it at expiration, delta goes to -1. So they have more futures to sell. They don't have enough of a short position. Sorry, I think I said that wrong. Delta goes to 1, not -1. So as the delta is increasing, they need to sell more to offset it. So again, this will push price away from the strike.
So the next thing I want to go over is the positioning itself and the structure and the different types of patterns, I guess you could call it, that show up in the profile. So basically, how I like to think about it is negative nodes are test levels. There's different behaviors if we are above or below them. And these, for me, they define the range that we could trade in. Positive nodes, like I said before, they're like magnets, and I like to think of them as like balance areas. Price tends to be sticky around these levels. They can also be support and resistance depending on some other factors and how big the nodes themselves are, as well as what the gamma heat map is showing. And the key for using the positioning in your trading is using then statements. So an example is, let's say we're looking at this node right here, this big yellow one. The price is coming up into it. If we reject off of it, then one thing is going to happen, and that one thing is probably a continuation lower. And then if we break above it and hold above it, then another thing is going to happen, and we're more likely to continue higher. So that's kind of how I think through it is if this happens, then that will happen. If something else happens, then a different thing will happen. So before I get into this example down here, I just want to make something clear that this won't always give you a clear thesis or structure or trade idea. A lot of times what you'll see in the profile is something like this, where it's just alternating, negative, etc. And if the profile ever looks like this, I would just not even take it into account. It's not clear what's going to happen. Best kind of profiles to see are things like this, where you have clear big nodes as well as clustering of certain nodes like this. If you see a cluster like this or a cluster like this, it's pretty clear what might happen. But if you see something like this, I typically just don't even look at it. But getting back to this, so negative nodes, test levels, positive nodes, magnets, balance areas. So just an example, let's say we're trading up here, right here. If we get to this node and we fail from here, we're likely to go back to the positive node. So this would be our magnetic area that price will be attracted towards if we fail this level. And let's say if we do get back here, you could expect choppy price action. If we fail below it and get back to this negative node down here, if we hold, again, we could continue or reverse higher back to the balance area or back to the large positive node, consolidate, break above, look for the negative node again. And then finally, if we end up breaking this positive node, then a continuation is likely. And where would the target be, or a potential area that we could stop? The next largest positive node in the profile. So one of the best things to see is when there's a cluster of nodes, and the question is which node to use. You got this one down here, and then you got three others, and then you got this bigger one. So for me, the biggest one is always going to be the most important. It's going to have the most influence, and that's with either positive or negative nodes. So in this scenario, the positive nodes, this largest one is going to be the most important. And with the negative nodes, this largest one is going to be most important. Obviously, it's not always going to look this clear. There's going to be times where it's just a bunch of smaller nodes. And when they're small, I typically don't really pay attention to them. I like to see nodes that are at least 1,000 net. So 1,000 net long options at a strike or 1,000 net short. Those are the ones I typically pay attention to the most. If it's under 1,000, I typically don't look at it because there's really not going to be that much of an effect. So a profile like this is pretty strong. If I see this profile and we're moving up, there's a high likelihood that we'll end up at this node here. And Same thing for the downside. If you see something like this, expect us to get to this node and then wait and see what happens at it. If we bounce, or if we're holding and we end up bouncing, then expect all of this downside to potentially be recovered on the bounce. Because with the hedging behavior, negative gamma, they got to buy on the way back up. A position like this is just like a slow drift higher. So if I'm in a trade and I see this, I'm not getting out. I'm holding for the largest node because likely that's where we'll end up. So where a position like this will create a heat map that kind of looks like this, where we have lower negative gamma below us. And then as we go higher, we have more positive gamma. So it's just a supportive flow higher. And then once we get to the peak, or in this case, the largest node, that's where the gamma will be at its maximum. So it'll be hard to get through that just because the dealers at that node have the most gamma, which means they are going to be selling the most amount of contracts that they need to as we get to that strike. So it'll be hard to get through it, but it will have this magnetic pull towards it. And if we end up getting enough real buying to get above it, that behavior then flips. Now the largest positive gamma is below us. So as we go lower into it, market makers will have to buy more and more, and that'll support the price. So once we get above it, the hedging behavior flips. So now we are buying as we go down more and more and more. So either we get stuck in this area, or if the buying continues, then we can move higher. And as we go higher, there's less and less gamma. So there's less resistance to move higher because the market makers are going to be selling less and less on the way up. So this is, I'm pretty sure people kind of call this like a call wall. I don't really use that term, but typically just call it a gamma peak, where we're going to be slowly grinding up into it. We could stay here, we could reverse from here, but if we do get above it, then the behavior flips and it'll be easier to move up, harder to move down, because there's going to be so much buying at the level. So let's say you're in a trade, or you're thinking about taking a trade. I trade mostly value, so the example I'm going to be using is prior day value high. So let's say we're above it and we come down, retest it, and we hold. So that's a potential long setup for me. One of the best ways to use this is for targets and price expectancy. What will price do, or what will price potentially do? So if I see something like this where we got positive gamma above us and the largest node is all the way up here, like I was saying before, is if I'm in this long, this is my end target. You could take scales on the way up however you want, but this big node up here, that's the end target for me. And why it's the where I would target and get all out if we do get up there is because of this behavior, what I explained before, because it's going to be hard to get through it and it's not worth it to hold on to in case we don't, because we could very well fail at that level and then move all the way back down because there's less and less gamma supporting us on the way down. Another way to do it is using or looking for confluences at the level. So again, same scenario, and now let's pretend that there's this negative node also lining up with prior day value high. That'll give me even more confidence to take this long trade, because if we do hold this level, this node, hedging of this node will drive us higher towards the positive gamma node, which is up here. And it's also a good way to tell if you're wrong, because if it doesn't hold here and we get back below, then it's the opposite. So one of the things I would caution people from doing is just blindly trading off these levels themselves. I'm a big fan of using order flow to confirm an entry, and if you're using this as well, I would also say use order flow to confirm it. There's no true way to see the market maker's activity in a footprint chart or the DOM or time of sales, whatever you use. There's no way to know that we're coming into this large positive node. There's no way to know that the flow that you see is the market makers selling as we go into it. So getting into a trade using these levels, I would just recommend using any entry system you would use for any other level. Negative gamma, we should see more aggressive orders. Positive gamma, they should be passive, but it's hard to exactly see the market makers hedging. If I were to say you could see it, I'd be lying. There's no way to pick it out from all the other orders that are going on. The way I like to use order flow is just looking for absorption. That's my favorite way, and I feel like that's the most impactful method of reading the order flow. So if we are at this positive node up here and we see a ton of transactions on the ask, but we can't move any higher, then potentially we could reverse that move. And maybe the people that were passive up here were the market makers selling as we moved higher. There's no true way to know for sure, though. So this was from today, April 24th at 9:10 a.m. These was the positioning, the gamma heat map, and the charm heat map as of 9:10. I first open up platform. Main thing I'm looking for is where the largest nodes. I always keep track of where those are. So for negative, it would be 71.65 all the way up here. Decent one at 71.50, 71.15, and then 70.90. You had bigger ones down here, but we were opening around here, so the likelihood of getting down here is not likely at this point. And then positive, we got one all the way up here at 71.85, 71.60, slight one at 71.25. Using the negative ones as the tests or the ranges, I see 71.15 to 70.90. This could be an area we trade between, with 7100 being the balance point. If we get above 15, then I would expect 71.25 to be the first target. Could around here. If we continue higher and get above 71.30, then I would expect 71.60 to be in play, with 71.65 being the where we could top out. You kind of two potential ranges at play. You got one from 70.90 to 71.15 with the balance point at 7100, and then you got one from 71.15 to maybe 71.50 or 71.65 is the more obvious one. Potential balance points at 71.25 and then 71.60. So if we open up SPX chart, we opened up at about 71.25-ish, somewhere in there. Based on the positioning itself, we had 71.15 as the test or the range low, and 71.30 as kind of weak range high, or 71.65, with the balance point being 71.25. Going into the market, those would be the key levels that I would watch. And if we fast forward to the open, this was at 9:40, so 10 minutes before or 10 minutes after the open. You could clearly see now 71.15 got bigger, as well as 71.30. So now what I'm thinking is this is our range that we could trade between. 71.15 support, 71.30 resistance. What happens? We open up. Actually, I'm going to skip ahead. I'll go to 950. Let's do 10. So 71.15 is the potential range low, 71.30 range high. Look at how well that played out. Obviously, you're not going to work out or be this precise every time, but it just gives you an idea for what potentially could happen. So 71.15 held, traversed to 71.30. Now, if we get above 71.30 at the 10 a.m. timestamp, actually, let me go. When did this break? So 10:40 it broke out. So let's just skip ahead. So if we get above 71.30, now 71.50 would be the target. That's where I would expect price to go. So we got above 71.30, and with the help of news, we got to 71.50 and even a bit higher. So this was at, let's skip to 11.44 or 11.40. So right before the news happened, that big spike, 71.50, big positive node. So that's where I would expect price to go. If we get above that, 71.60, with 71.70 being the potential high, could have gotten to 71.80. That could be the level. 71.60 was the key level where we could see a slowdown in price. So we got right to it. And then as time moves along, so from like basically the end of the day, we kind of chopped in a range. Now this is the 110 positioning kind of. So now 71.40 would be kind of low that I would expect. 50 would be the key area to hold. And basically just expect to chop between 71.60, 71.50, 71.40 to be the area to hold. And we pretty much came down here, held 71.50, and just kept chopping between the two biggest positive nodes, or not the biggest, but the positive nodes as the balance point. So looking at another example, this was from Thursday, the 23rd, when we had that big move lower. We take a look at the positioning. We had a negative node at 71.05 right here, positive one at 7100, and then the lower negative node at 70.70. We didn't pass the test. We failed holding this negative node, so we move lower, which is what happened. We got a retest of 7100. Couldn't get above this large negative node, and we continued lower down to the next range low from the 70.70 strike. And if we look at the gamma heat map, we started selling. We went into a pocket of negative gamma, so that just helped. It made the move lower easier because as we went lower, the market makers are selling with the move. So it's just easier for price to go lower as we move through the negative gamma. And if we fast forward through time, just as quickly as we moved lower, we basically V-bottomed and went all the way back to where we started through this pocket of negative gamma. Because once the selling stopped, found buyers at the low. Now as we move up, the market makers don't have to sell with the price anymore. They actually have to buy as we go higher. So that buying that the market makers have to do helps us get this sharp reversal. Example of how negative gamma can affect the price. And you're in a trade and you see negative gamma and we're going in the direction of your trade, just hold it until you see something that tells you not to. We get these sharp moves in both directions in negative gamma. So just to recap, use the positions by strike chart to find your test levels, potential ranges, and potential balance points. So this is the positioning for Monday as of close at 6 p.m. So clear big node at 7200, lower one at 7140, with a cluster of positive from 7170 to 7160. If we were to open up here, 7200, if we fail that, look for a move lower towards this cluster of positive gamma, and look for this cluster of positive gamma to be supportive, price up. If it does that, we could rotate higher. If it fails, look for 7140 to be the range low, the test area. If it holds that, likely back up towards this positive cluster. And if we fail that, look lower. Heat map, it's best to use it, get an idea of what price could do. And what I mean by that is, are we going to be choppy? For areas of high gamma, we get up to an area where there's a lot of gamma, we could slow down. There any pockets of negative gamma? If so, wider movements, price, more volatility. Gamma obviously would be volatility. choppy price action. Um, use that in trading. You're in positive gamma, use smaller targets for your trade. If you see that we're in negative gamma, I would hold for bigger moves. Heat map just gives you a passive participant in the market, gives you a passive drift in one direction, is directional. So if we're in the blue, that means it is supportive, and as time expires, market makers will have to buy. We're in the yellow, it's a passive drift lower. And one more thing, I would not use this on its own. It could work, but it's definitely more powerful and more impactful if you use it as a confluence with your trading system. Have levels, value levels, or whatever you use, and there's also a large node that's also there. Then that gives you a higher probability setup that your trade might work out.